Hey, today we'll be looking at Activision and Twitter. Both of these companies are being acquired and are currently trading at a discount to the acquisition price. Activision has an expected closing date, while Twitter only has a deadline before the deal is terminated. Let's have a look at Activision first. For Activision, the SEC filing states that the completion of the merger will be 30 June 2023. That's over a year from now. I have a chart on Google Finance that shows the stock price and the discount all spread between that and the acquisition price. This discount or spread exists because the market is pricing in the chance that the deal doesn't go through. I have an overview of the risks on this slide and we'll go through them one by one. The first thing is the termination fee. If Microsoft decides to back out of the deal, they have to pay 2 to 3 billion, which is much lower than the 70 billion required for the deal. Activision also has to pay a fee if they decide to back out, but that scenario is less likely. For a company of Microsoft's size, 2 to 3 billion is really nothing. Just for some context, they make over 40 billion each quarter. Next, we have the Federal Trade Commission, or the FTC. In recent news, there's some senators calling for FTC to review the deal. The current FTC has also been rather aggressive in blocking deals, with the most recent being the Lockheed Aerojet and NVIDIA ARM acquisitions. It's hard to get a gauge of the video game industry because companies like Microsoft and Sony only derive a portion of their revenue from video games. However, if you look at the market cap alone, Activision is actually one of the larger players. While there's an argument to be made that it's not a monopoly since people have choices and there are still large developers that are private companies, the market cap paints a different picture. Personally, I don't think it's a monopoly, but then again, I'm not the FTC. Before the deal was announced, Activision was trading closer to $65. There was a run-up from the bottom that might or might not have been Berkshire averaging down. This price was before the whole Ukraine war, yield curve inversion, Fed rate hikes and inflation. Without the deal, Activision would probably be trading even lower. They even had a pretty bad first quarter result. If the deal falls through, will it be trading at $65 or even lower? So there's a few ways we can play this out. The most obvious would be to do nothing and just ignore the stock. If you think the deal will go through, going long shares lets you capture the upside of about a 20% annualized return, which is pretty good in the current environment. In addition to that, you could even sell cover calls since we know the expected date closure. Writing puts is another way to profit off this acquisition, but if you look at the chart, it's not exactly easy since the price has been dropping since the announcement. If you had sold in the first few days of the announcement, you'll probably be sitting at a loss even with the option premium. If you're bearish, writing calls, shorting or buying puts might be worth exploring, but to me it's too risky. Now, moving on to Twitter. The actual acceptance by Twitter's board was on 26 April, but Elon expressed interest as early as 4th of April. Spread for the deal was a lot smaller compared to Activision, but it still has its own risks. Let's go through that. The first thing is the 1 billion termination fee versus the 44 billion deal size. Elon's source of funding come in three forms: debt financing, margin financing, and equity financing. The debt financing is made up of both secured and unsecured loans, while margin financing is based on his Tesla shares. There is some speculation on where the 21 billion of equity financing is coming from, whether it's from his existing Tesla shares being pledged or his other private companies. There's a lot of speculation that if the price of Tesla drops too much, it might affect his ability to purchase Twitter if he can't secure additional funding. Next, the FTC might also try to block the deal, but the experts say that it won't. There's a bunch of Twitter alternatives like Mastodon or Gather. It's more of a lack of users and convenience for most people. Elon acquiring Twitter also won't lead to a monopoly as none of his other businesses aren't in the social media space. So for me, I think there's a low chance that this deal will be blocked. Similar to Activision, Twitter was trading at a much lower price before the announcement was made. Their latest results were also kind of bad, with much higher operating costs, and they would have made a loss if not for the divestment of Mopar. There's also an issue of the monthly active users being reported wrongly for the past few quarters. On the upside, there might be some interest in taking over Twitter, as seen from Thoma Bravo. So, there are a few ways to play this out. You could go long shares and capture the upside if the deal goes through. Or you could write cover calls as well. Cover calls are a lot more risky in this case since there isn't a definitive timeline and we only have a deadline. so the deal might end up closing much earlier, and you lose the upside. Writing puts also lets you profit off the time decay. And if you're bearish, shorting or buying puts might be an option if you think the deal won't go through. In summary, the discount or spread exists because of the chance that the deal will not go through. If you look at the AMD Xilinx chart, Xilinx traded at almost a 40% discount to AMD, but this was a deal that still went through. Still, there's no free lunch and there's always a risk that the deal will not go through.